Welcome back to Everything Money. We're glad you joined us for another video. As always, it's Seth, Paul, and Mo analyzing stocks here on our channel. We welcome you in, people all over the world. Paul, I just love seeing our patrons, and I love you guys in the comments. Thanks for joining us. Today, we're talking about Tencent. This is a Chinese company. They offer internet-related services and products, entertainment, AI, technology. This is, Paul, the Chinese companies have been beat up the last couple weeks, and this one too has fallen. One of the people we really look up to, Manish Pabrai, has been a huge proponent of Tencent for a couple years now. A company out of South Africa, Napers, has an enormous stake in Tencent. We're going to look at what the heck this company is from a fundamental perspective. You might be seeing it in the news. Obviously, if you're following stocks, you're seeing the Chinese stocks have been getting decimated of late. This is another one. Some value investor people that we like love this company, so we're going to look at it right now using. And
the stock is down 40% since its high in February. Okay,
Amazing. So
again, when we tell people these things happen, they don't believe us. Sometimes this is what occurs. So market cap $560 billion, PE of 21 after falling 40%. So that's an X, but a great profit margin here, 35%. Check mark there. That's pretty solid. They have a dividend yield of 0.35%. I'm not even going to acknowledge that because that's embarrassing. It's
Keep
adorable.
going.
Now let's go to the financials. Now, guys, this does vary from our software. This shows just full annuals. So, but it's still good enough to see they're on track, 22.8 to 69 billion. That is over triple the revenue in the last 5 years. Net income, also 6 billion to 23 billion. Check mark there. I mean, so far I'm liking this.
How about shares outstanding, Paul?
Shares outstanding is 9.376 to 9.49. So it's an X there, but really not by much. That could easily just be because people exercised some stock options and did that, right? So not worried about it as much.
Current assets. Folks, if you're following along at home, we do offer a software with all of this data through our Patreon. We can get into it later. Currently, Tencent is on Y charts and not our software, but we'll have that in the future. So keep going, Paul. Pillar number 6 is current assets over current liabilities.
All right, $50 billion in current assets and $43 billion in current liabilities. So that is a check mark there.
How about free cash flow, Paul?
What am I going to ask you to do now?
Well, I was going to ask you. They do this. They use free cash to make acquisitions, pay their dividends, buy back shares, and so they have to have a lot of it.
Pay down debt.
And you love this metric.
Yeah, but I'm asking you to pull out your calculator.
Oh, my Lord.
So our software will do this math for you automatically. It'll tell you the free cash flow by year. But when we have to use other software because we don't get this company in there, I make Seth do some work. He's usually just comfortable being a pretty boy on the screen. Mm-hmm. So is your calculator open?
Unfortunately, yes.
Okay. So free cash flow is cash from operations less your capital expenditures. It went from 7 billion to 18.5 billion. So that's a check mark. The other years are 11 billion, 8.6, and 13.3.
So the average free cash flow over the past 5 years is 11.7, Paul.
Times 20 equals
234
billion.
Yep, 234.
And the current market cap was?
560.
Very expensive. Now,
what?
Guys, in our software, we have a stock analyzer tool that allows you to go look at the growth of the company, because when it comes to fast-growing companies, you should be willing to pay a premium. But this just seems very expensive right now, so it's selling for basically 40 times free cash flow. Actually, over that, 45 times free cash flow. This is a hard pill to swallow, right?
This is bonkers because this was almost double in February, Paul. I mean, if it's overpriced by this far right now, I mean, this is absurd.
Yeah, it's a lot. And that's the thing. It's like, guys, could this go down more? I mean, but Manish Pabrai likes this. He probably has some value reason why he likes it. I just don't know what that is.
I think he liked it I think he was in love with it a couple years ago. I'd love to get an update on him if he still owns this or what he's holding. I think he does, Paul, but boy, he probably enjoyed this run-up here.
Yeah, but where was the value play in the run-up? So the big thing, guys, is just because a stock goes up doesn't mean it goes up for the right reasons, right? We go back to every example from the 2000s. Intel, Cisco, hit all-time highs. They've never beaten those all-time highs since, even though the revenue and profits up significantly since then. Because if you overpay for growth, it'll end up hurting you in the long run on a portfolio basis. The only one I really know of that worked was Microsoft and Amazon, and those are massively overpriced today. But still, I look at this company going, it's got a lot of checks, except for the value part. The value part just stinks. So I'm waiting for it to go down further. I'd love to be able to put this in our software. Actually, I do have an Excel sheet. So why don't we go to Mo real quick and see the
Mo, are people trading Tencent in the Bidnask Nation?
So I haven't heard of
group?
anybody trading this, but this could be an opportunity for you to day trade. We're going to check that out in a second. But look at this, $99.40, and it's down to just under $60 a share. So that's been an incredible decline. Now, just be careful with this. Your stochastic is just kind of floating around at 31%. Now, this one's tough for me to say get into from a long-term chart, just because of everything, all the geopolitical stuff that's happening. Any announcement from China or the United States can make this thing gap up or gap down. I wouldn't want you to get stuck in that. So my suggestion is go over here to the 15-minute chart and go ahead and day trade it if you can. To me, there's days that you get a little bit, maybe an hour worth of a trade where you can get over 80%. To be honest with you, Seth, this is not a great. I'm actually very surprised. This is not the best stock to day trade. This is. I think I'm just going to say avoid all around until everything settles down with all the geopolitical. But I was expecting there to be a lot of volume in here where you hang above 80% for a long time. You can catch some gains up. Hang below 20%, you can catch some gains down. But I'm really not seeing it at all. I'm surprised.
All right, guys. So we're going to do a very rudimentary version of the discounted cash flow model in Excel. You can do this with every Excel, or you can join our Patreon, get the software, does it for you in a much more organized way. So Seth, first, what we're going to do is what was the market cap? 550 billion?
Yeah, 560.
560. So we're paying $560 billion for the company. Cash flow, we're going to assume growth of free cash flow of, what's it growing right now? Free cash flow right now is growing. It is increasing, which is important. And it's also growing by a pretty good amount, 13 to 18. So we'll call it, for the next 7 years, we'll call it conservatively 15% free cash flow. We want to pay 15 times. And the cash flow in year one will be 15% of 19. Let's call it 20 billion even. So right now, you're getting, if you pay $560 billion to the company, you're getting a return of 6.37% on your money based on a multiple free cash flow of 15.
Not that great.
Not that great. Now, if you buy it for $300 billion, oh, boom, 18%.
I see. So what you're saying is this is where you consistently say is you're already paying for the growth. You're already giving them the money before they've grown there.
Correct.
By paying the market cap
today. So it looks like $400 billion about what you should pay for the company, which is about a 30% decrease in the share price. It's currently at
$58.
$58, so 30% lower. Call it low 50s. You'll be able to get a 12 to 13% return on your money, which I think is appropriate for a value play. A lot of value investors I know do a 12, 13% IRR. All it is math, guys. All it is math. I'm sitting there assuming a 15% growth rate in our free cash flow for the next 7 years and an exit price of 15 times free cash flow, which is very reasonable all around. So I'm looking at this saying, now, here's the thing. If your free cash flow is going to go 20% a year, all of a sudden you can pay your $550, your current price will get you about a 10% return. But to me, that's a lot of payment for a very high free cash flow growth, which means in year 7, they're going to do $60 billion in free cash flow. They're going to triple essentially from today. That seems like a lot. Could I be wrong? Absolutely could be wrong. But the point is that's where we stand currently on the company. I just think it's a little overpriced for my taste. But Manesh Prabrai seems to like it, and I respect him very much. So who knows? I'm probably missing something in the company because remember, we're not doing a deep dive. We're doing a very high-level view and starting to say, hey, listen, should we go further? For me, I probably wouldn't have gone further on this company much more. Now, I do encourage people, go out there, see what other value investors are saying about this, like Manesh Prabrai. Remember, we don't like to look very, very detailed in the company early on. Because if we do that and there's 10,000 companies out there, you're going to waste a lot of time. A lot of people criticize it saying, you don't know this. We don't. We're looking at the numbers and say, should we justify it? It's just like dating. I don't need to go on, if somebody tells me and says, hey, I've got this woman for you, she'd be great for you to date. Great, tell me about her. Well, she's 18 years old, she's addicted to heroin, and she's all about...
This sounds like your type.
Exactly. So I'm listening to say, why should I look any further? I have no need to go on a date with her. Could she be the one for me? Sure, but is she likely to be the one for me? No, don't waste your time. But if you really like the numbers here and you think it's potential, go see what the people you respect are saying about the stock. It doesn't mean they're right, but go see what they say, because I respect Charlie Munger a lot, and he liked Alibaba's numbers. He believed them, so I believed them because of that reason. I didn't listen to Charlie Munger's valuation of Alibaba, but I believed him when he said those things.
That is our take on Tencent. We'll continue looking into this company. I'd like to do some more research on this. We use our 8 pillars to look at sort of our initial screener. And like I said, some people we look up to definitely like this. So I'd love to learn more myself, and so should you. Join the Patreon. You can learn more about investing in this company and trading with Mo. The link is in the description below. Fondle the thumbs up on the way out, and we'll see you at the next video. Thanks for watching.